Hey guys, Omar Khan here with Theta Trading, and today we're going to talk about the Canadian housing market, and not just the Canadian housing market, but housing prices in general, and what exactly is affecting that. Before we do that, if I could ask you guys a big favor, if you would not mind, please hit that like button, hit that subscribe button, and if you like what we do here, give us a comment on what you'd like to see in future videos, and also, if you'd like, please book a call with us to find out more about what we do here at Theta Trading, the link attached. Okay, let's get on to today's topic. All right. So, how will the Canadian housing market do in 2023? Well, the answer is, again, like the stock market, no one really knows. However, you can say this, that housing is a lagging indicator, meaning it will impact itself, or it'll have the impacts felt after interest rate hikes. So what's been going on in the economy? Well, what's been going on in the economy is we have had a lot of interest rate hikes. And why was that? Well, the reason was because in 2020, the banks and the governments around the world printed a bunch of money to get us out of a very tight situation, which was COVID, right? Nobody was paying rent, people weren't buying stuff. All that was happening during COVID, okay? Now, if you're not going to work, someone has to be able to fill that void, and that was the federal bank, the Federal Reserve in the United States, the Bank of Canada in Canada, and they printed a bunch of money. That money has now led to inflation, right? Because inflation is defined as the too much money chasing too little goods and services. So they printed a bunch of money to get us out of a really tight spot in 2020. That was good. All right. Now the question is, did they print too much? We don't know. And as a result of them printing so much money, the value of money has declined, right? Like it's just worth less. And that has had an impact on the real estate market. Why? Because now they've had to increase interest rates in order to combat inflation. So let's take a look at this. So I've got a little thing here. This is from Forex Live, but it encompasses what we're looking at here. So the FOMC dot plot and central tendencies from December 22nd meeting, end of year 2023, 4.8%. So the main thing to know that is that the dot plot is the Federal Reserve in the United States. The various members of the Federal Reserve indicate where they think interest rates will be in 2023, 2024, and beyond. Okay, so what happened during this last meeting in December, just a week or two ago, is they came up with a dot plot scenario where they think rates will actually have to rise in order to combat inflation. Now, the market had been anticipating about 4.6%. But you can see from this article here, the dot plot for December 2022 shows a median rate at the end of 2023 at 5.1% versus 4.6% at the September 2022 projection. So what does that mean? That means in 2023, the median person in the Federal Reserve thinks that the interest rate that will need to be had, that will need to be reverberate to the economy itself, will have to be around that 5.1% mark. Now, that's not good for real estate, right? Because if you're going to be paying more for real estate, guess what? It's going to cost you that much more to buy the thing, right? And you have to really strongly consider whether you want to be buying real estate or not right now. So initially it was at 4.6%. And now it's gone to 5.1%. So what does that mean for real estate? Well, that's probably not a good thing for real estate, right? Now, the reason the stock market is adversely affected from high interest rates is twofold. All right. So first one is that if I can get a rate of return of, let's say, 6% or 7% with a deposit of some sort, like let's say a GIC, because if interest rates are at 5, I'm going to get a bit more than that, right? 5.1, but I should get a bit more than that for just depositing my money. Let's say I get 6%. And 6% is guaranteed by the government. Do I really want to invest in the stock market? The stock market on average has returned about 10.9% a year for the last 50 years. That's the S&P 500. So you have a roughly 11% rate of return in the stock market, or you could get a guaranteed, let's say, 6% rate of return. Which one are you going to go for? You might just say, you know what? I'm happy going for the 6% return. And that might be the case. Now, if you're looking to invest in the housing market, you can see here rates still have to go up about 1% more. And rate impacts are not really felt in the housing market until after they happen, even though we know they're going to happen, right? The Federal Reserve and the Bank of Canada have no choice but to keep increasing interest rates, and they are doing so. You keep seeing it. Every so often, they increase another half point. They increase another half point. They increase another half point. You're like, when will this end? Well, it will end only when inflation is tame. So in my opinion, if interest rates are going to be higher for next year in 2023, I still think the real estate market will have some room to correct. I would suspect probably another 10 or 15% in the more inflated market, let's say like Ontario and British Columbia, but less so across the rest of the country. And there's no way of knowing for sure, but think about it logically. If it costs you that much more to buy a home because interest rates are that much higher, are you going to pay the same for that home? Or are you going to say, you know what, I'm willing to pay a little bit less because I can't make the payments? Well, that's generally speaking how it works. So I don't think housing prices will come down anytime soon. And if rates keep rising, right now we're at about 4% on the Federal Reserve rate in the United States. Okay, so if they are correct and they're saying that we're going to be at 5.1 next year, that is an additional 1.1% that rates would have to go up. So take a look at this dot plot. In 2024, median funds rate is targeted to be 4.1% versus the 3.9 they expected in September. And for 2025, 3.1% versus the 2.9 that they had projected earlier in September. Now, this means that the Federal Reserve is saying, wait a second, inflation is not really under control yet. Inflation is more of a problem than we would have guessed. And if it's more of a problem, what do they have to do to combat this inflation? Well, they have to raise interest rates. And that is what they are doing. Now, raising interest rates, like I talked about, is not good for the stock market because twofold. One, you can invest your money at a higher rate of return in, let's say, like a GIC or a CD if you're American, like a guaranteed rate of return backed by the government. So you're going to be less inclined to invest in the stock market. Secondly, if you're a company looking to grow your company, what do? You take on debt. You borrow money to grow your company. A couple of years ago, or at least a year ago, that money was almost free. Now that money is costing you a lot more to borrow. So you're going to be much more reluctant to borrow it, and the value of stocks gets pushed down as a result because the stock market says, well, hey, it's going to be much harder for companies to grow. Inflation is definitely a problem, and things are not as rosy as we would like to see them. Now, what the banks around the world are trying to do is they're trying to get this thing down to around 2%, right? They're trying to get inflation down to 2%, and it's not easy. Right now, the last reading that we had was 7.1%. Now, it's been coming down from a peak of about 9.5%. Now we're down to 7.1%, and it's showing a decline. It's showing a good decline. But if interest rates a year ago, if you were buying a house for, let's say in Canada, you could have a fixed rate mortgage at low twos, and now you're renewing this year and the high fives or the low sixes. Well, guess what? You're not going to be able to afford as much of a home anymore. If you have a $500,000 mortgage and you were paying 2% and now you're paying 6%, that's a big difference, right? 4% on $500,000, that's $20,000 a year just in interest. So are people going to be rushing out to buying homes? No. It does not change one thing though. In Canada, we still have a housing shortage, so that won't change. So this is more of a temporary thing in my opinion. So if you're looking to buy, you want to be buying at the point of maximum amount of fear. That should happen according to the dot plot and according to the banks sometime in the middle of next year. Now, so let's take a look at this, okay? So 2023, 5.1% versus 4.6% last. That is not a good sign. That means inflation is still high and rates still have to go up. So expect another 1% or so on the upside. In 2024, you can see it's coming down. At least the opinions are, right? In 2023, even more so, right? And 2025 and beyond, you can see it's between 3.25% and 2.25%. So 2.25 to 3.25%. Versus now, where we are 4 to 4.25. So in a couple years from now, the Federal Reserve is predicting that rates will decline by approximately 2%. Now, this will be good for the real estate market long term. But in the short term, because rates still have to go up, it could very much be a problem in 2023. So I'm a real estate investor as well, and I look at the longer term, demographics. People are still moving into the country, still a lot of jobs being created. I am happy with the longer term demographics. However, shorter term, I just don't know where housing prices will settle down because I know interest rates still have to go up. So, guys, that's where the real estate market is shaping up in 2023. 2023, like I said, again, expect about a 1% rate hike. Okay, so if you're looking to buy a home, consider it probably about 1% more expensive sometime in 2023. And then, because inflation should be under control, or at least more under control, we are expecting rates to go down into 2024, 2025, and beyond. And that is because inflation is the number one battle that the Bank of Canada and the Federal Reserve are trying to combat, and they are doing a decent job of it. Inflation, like I said, is coming down, but there's still a lot more work to be done. Inflation last month, like I said, was at 7.1% on the Consumer Price Index. They want that number down to 2%. Now, yes, the economy, and what are they going to do? They're going to destroy the economy or really hurt the economy so that people have less money to spend. Therefore, inflation goes down, interest rates go down second. And they're doing that. It doesn't seem that they're really concerned about how much pain they inflict on the real estate market or the stock market. Their number one priority here is to lower interest rates and lower inflation long term. So they're looking to get to that 2% number, guys. We have a long ways to go. The stock market generally, like I said before, recovers ahead of time, but the housing market is a lagging indicator. It's going to feel the effects of this additional 1 percentage point increase in interest rates, and that is going to be a problem for some time. All right, guys, I hope you guys enjoy this video. If you want to see any videos that you have that you'd like to see in the future, a topic that you'd like to see, please let us know. Hit that like button, hit that subscribe button, and we'll see you soon. Omar Khan here from Theta Trading. Take care and talk soon.